Good afternoon, everyone. I'm Jonathan Parry, an equity capital markets partner at White & Case, and I'd like to extend a very warm welcome from the firm to the first of our Windows of Opportunity spring webinar series. As I hope you know, today's topic is IPOs, London calling, and I'm delighted to be able to introduce a panel of the calibre we've managed to assemble today. But before I do, a couple of housekeeping points. We'll be taking audience questions, and these should be submitted using the Q&A function. We'll also be doing some live polling, so watch out for those throughout the sessions and please do participate. If you experience any technical issues, please email emir.events@whitecase.com. And as a reminder, this webinar is being recorded and a copy will be available after the event. Finally, you should be able to see an animation of this session on screen. This is being created live and will document the ongoing discussions. We'll be returning to this during the session and sharing with you all after today's webinar. So, joining me on today's panel is Philip Stafford, the Financial Times correspondent for exchanges, trading and markets regulation. He's held this role for 7 years and has been leading the FT's coverage of Brexit and financial markets. He won a Sabu Award for his coverage of flash crash trader Navinder Sarao and also runs FT Trading Room, the FT's microsite devoted to market structure. As part of a 20-year career at the FT, he's also been UK stock markets editor, small cap columnist, and UK tech correspondent. He's also worked for the FT in Tokyo. He started at Bloomberg as a commodities reporter in '99 and was part of the team that developed financial website FT Market Watch during the tech boom in 2000. And prior to starting a career in journalism, he was a teacher in Japan. We're also being joined by Silvia Viviano, who is head of the EMEA Equity Capital Markets Execution Team at JP Morgan. Silvia joined JP Morgan in 2004 and has worked in various capacities across ECM since then. Silvia began her career covering Southern European clients and was instrumental in establishing JP Morgan's presence in these markets. For the past 8 years, Silvia has been a core member of the ECM execution team, and she provides experienced support and oversight of the most complex ECM transactions in the market, while at the same time working with in-country teams to structure idea and customized processes. Finally, we're joined by Charlie Walker, who is head of equity and fixed income primary markets for the London Stock Exchange, and is a capital market specialist, having previously worked within JP Morgan's ECM team, responsible for originating and executing equity transactions. He has assisted in raising over £45 billion worth of equity capital across 5 continents on behalf of clients. So in today's webinar, we're going to be talking about London's current position in the global market as a destination for businesses looking to IPO, and how that position has changed over time. And in light of Lord Hill's recent recommendations as part of the UK listings review, and Ron Khalifa's review of UK fintech, we're going to talk about how London's position might evolve in the future. So after that introductory piece, I'd like to turn to Philip to provide an overview of how London has developed over time as a listing venue.
Well, hello everybody, and thanks for joining. Well, I suppose in the if you read your FT, as I'm sure you did in the last few days, you've probably seen quite a few listings and IPOs that are happening in the London markets, and you may wonder, quite why this is an issue. Lord Hill's report at the start of this month laid out, in his view, what some of the problems were. I thought it must have been a little bit over-egging some points of it. I don't think it's any surprise to know that the UK has been losing out on listings in the last decade. It's not quite as big as it was, say, before the financial crisis. But I think it's important to put it into the context that London never has been the world's #1 place for IPOs by deal value. It's usually trailed New York. But having said that, the gap between the two has probably never been as great as it is now. Hong Kong, which often tracked London maybe 15, 20 years ago, has now far surpassed the UK in terms of the IPOs and the value that funds that it raised there. And it does look quite stark when you put some stats out there. And I think also the other factor that not just hasn't just affected just the UK market, but is the fact that fewer companies actually just coming to list in general, and so the market is shrinking. There have been reports. One company, Oxera, has suggested the UK market is shrinking faster than others in Europe as companies go off market and haven't been replaced. Now, the reasons for this are many and varied. I mean, the first thing that everyone always thinks about when they look at when they think about the UK is Brexit, and there's no doubt that hasn't helped. The years of uncertainty haven't helped. The value of the FTSE 100 has underperformed many of the other global benchmark indices. This year the uncertainty is cleared, and we were already seeing a bounce back in IPOs. Having said that, there's plenty going on in other markets as well. But what you has, as Lord Hill's report did point out, that what the UK market is largely left with is one that is relatively top heavy in what you might call old economy stocks of banks, mining, oil majors. Now, very reliable and companies in which they're going to pay dividends year after year, but they're not the same sort of go-go technology stocks, like Ant Financial in Hong Kong, or dare I say Tesla, or many of the US tech firms that give you those huge valuations. And so, this is where London is suffering when you make these comparisons. And clearly, the report actually, Lord Hill's report, wants to address this. What perceived as the lack of technology or high growth stocks, and this, I say, there has been an erosion for many years. I can understand why, that it does create something of a cycle. It's hard to break. If you're a tech company and you want to go and you want a high valuation, then the chances are that you look where you're going to get it. Now, you get a decent valuation in London, you may well get something far more to your liking in the US. I'm afraid that's the nature of global markets. So, but also you've also now got this wave of companies that are much more looking to go public in a way that they probably haven't for the past decade. We all know that the interest rates have been on the floor, but it's been private money has been very easy to come by. And therefore, if you're a growing company and you've been looking for funds, then it's been very easy to actually just use debt, and that's what they've done. But the cycle has turned, and what you're actually seeing, a lot of these companies that have maybe stayed off market and now actually wanting to come onto market. And this is where London. Lord Hill is saying, well, actually, the rules over here are particularly unhelpful. But I think it's important to say that these rules aren't actually created or imposed by the EU. They could probably have been done beforehand. Brexit has given that impetus to actually look at them properly. But whether the UK can retain this status, it's going to be a hard thing to do. Once you've created a place where people know that you can get a decent valuation in a certain place, you've created an investor base, a very knowledgeable one. People go there. London has benefited in that in the future, in the past. Sorry, I mean, please. For a long time, it benefited from mining and oil stocks that wanted to come here because of those exact reasons. But the nature of what people want to buy now has changed. But the one thing, and I'm sure this is really going to come up quite a few times in the next hour, is really whether the UK can balance off this this desire to change the rules with being comfortable with fund managers being comfortable with it. That sometimes when there have been high-profile failures from around the world, people like Boomi, NMC Health, every time that one of these happens, that there's always headlines and worries that the UK or the LSE is relaxing standards too much. And one of the reasons why the UK is so competitive is because of its very high standard, and so anything that would erode that is a concern. So this is where the trade-off will be with the Hill report. This has the LSE itself has advocated many of these changes, and it's tried many things before. It's tried a tech segment, and it's tried a connect program, with China, and it's been, I wouldn't call it roaring success. Not there've been some on there, but I think that the fact that this is the push that's for this report is created suggests that actually that there's something a little bit more going on this time, and the people want to change the premium segment, which is always been the LSE's gold standard. It's where all the biggest and best companies are on the market. But investors will still have these concerns. But I want to finish off with the first point that I made, which was really that the UK is it's not the biggest, but it is still amongst the best of the rest, and it does tend to pick up the biggest IPOs in Europe. Not necessarily the most in terms of volume terms, but it does tend to be the biggest, and that's not a bad position to be in. But nonetheless, it feels as if there's more work to do.
Great. Okay. Well, thanks very much, Philip. So, and that particular point you raise on investor protection and corporate governance considerations, balancing that with attractiveness as a listing venue is actually the topic of our first poll. So, if I could move to that. So the question of the first poll is: which of the following statements most closely reflects your opinion on Lord Hill's recommendations? Is it A, they strike an appropriate balance between investor protection and corporate governance and London's attractiveness as an IPO destination? Or B, do they go too far and sacrifice investor protection or corporate governance in order to make London a more attractive IPO destination? Or C, should the recommendations have gone further in seeking to make London a more attractive IPO destination? So please do register your votes, and we'll look at the outcome of that a bit later on in the webinar. But turning now to Sylvia, it'd be great to have your investment banker's perspective on the market, and in particular your thoughts as to which factors your clients bear in mind when they are considering which venue to list on.
Thank you, John, and thank you for having me here today. So, as Jonathan saying, I would like to give my investment banking angle, and I will start with an overview of what we are seeing in the market right now. So, as we speak right now, the 2021 started from an equity capital markets perspective, has proven to be very resilient, notwithstanding the COVID situation. We have noticed some macro themes that are pushing the markets, and they mainly are the consumer recovery, the expansion of the vaccination program, obviously the monetary stimulus and the monetary initiatives, and the economic reopening, which is slightly starting or not starting, depending by the day. But just to give you a sense, over the past 4 weeks only, we have seen almost $170 billion, which have been deployed into equity funds. And this is, to me, is a very clear sign of the trust that investors are currently putting into the economic outlook and also in the stimulus measures that have been put into the market and have provided a sustained boost for the stocks and the global markets. Looking at the equity capital markets transaction just in Europe as of now, I think this is a record quarter over the past 2 decades. Almost 30 IPOs, actually more than 30 IPOs have been priced in Europe, raising $16 billion euro, which is, as I said, is a record over the past 2 decades. And what we are seeing is that growing stories, resilient business, and the new sectors that we are seeing are booming on the back of the COVID, let's call it digitalization, are actually managing to get in price of a super compelling premium. And I was laughing yesterday because I got a message from one of the top investors, saying, only a few months ago, we were talking about 10-15% IPO discount. What happened now? Where is it gone? We are currently seeing something very peculiar in the market, and which we haven't been seeing for a while. Then a completely separate chapter is the one of SPACs. Last year, 2020, the US was considered the year of the SPACs, and $80 billion were raised only in 2020. Now we have not even closed the Q1 2021, and $87 billion have already been raised with the SPACs. And there are over 200 SPACs that have already been publicly filed in the US. Obviously, it's a crazy number, but it's a clear sign of a market which is currently booming in the US and which is getting dragged also in Europe. Looking specifically at the UK, also UK has its own record. I mean, after the Deliveroo and the Infrastructure Fund Digital 9 deal, which are due to price soon, we are expecting the UK to surpass the 2006 Q1 record, where 6.4 billion was raised via IPO. We think, pound. We think we will this year will actually go beyond the number. So now the question is, which is connected also with what Philip was saying, what's the issue with London? Why do we need this reform? And I think here I just want to give you a sense of what our clients are looking at when taking an important decision like the one of getting listed. So I would divide them into buckets. There are the, let's call it the local champions, some clients or some issuers that are value businesses with a solid presence in the local market and an heritage specifically linked to the country. And that for them is listing in the local market is a no-brainer. Actually, if you're going to choose another market, investor would actually ask you, why are you going into another market? It doesn't make sense. But then we have all this new category of clients, like the one I was mentioning before, which has linked to the digitalization process and the COVID recovery process and the stay-at-home new sector boomers, which actually, when taking the decision where to get listed to, they look at other factors, like they want to make sure they get a perception of being a global company. So they ask, if I get listed in a market instead of another one, will I lose my global edge? Then they want to make sure that from a liquidity and depth of the market perspective, getting listed in London or in the Netherlands or anyone else will allow them to attract the same group of investors. And then obviously there are all considerations in terms of regulatory framework and corporate governance. There is a shift for sure from old economy companies to companies of the future, and there are some new characteristics that we are seeing. What is clear to us as we speak is that both in Europe and the UK, tech companies have demonstrated that they don't need to go to the US to achieve a premium valuation. Then it's clear that also tech company founders, they want to make sure that they can stay in control of their companies even after it gets public, in order to make sure they can continue working on their strategies. And this is quite relevant considering that most of these companies, their results, or they come through multiple and increasingly large private funds injection, which means that the founders have lost the control and they currently own not a big stake of the company. And then the last point is obviously the strong interest coming from the investors. So again, going back to what I said before, why London need to be adjusted, why the listing requirement in London need to be adjusted. And I think this is a result of all these aspects that we have noticed in the market. London, it came clear to all the different market constituencies, including government and regulator, that the listing regime in London is not completely fit for purpose. It's very onerous for issuers, it's very rigid, and it doesn't really adapt easily to the flexibility and the speediness that the current market and the current client are requiring. if you make a comparison with Amsterdam, Frankfurt, even Warsaw, it's very clear that the London premium regime needs to be adjusted. It needs to follow or adapt to the current requirements of the market. It doesn't mean we need to drop all the, the London, the golden rules, which, as they are called, but we need to make sure these are not turning as a golden cage, right? And to me, what is quite significant is, if you look at the Lord Hill report, one of the first considerations from the Lord Hill is the FCA stance should change. They should keep on doing the rules, but they should keep in mind also the competitiveness of the environment we're making these rules. So I think we are really assisting here, in my opinion, as a cultural shift, right? The regulator and approach the regulation has to become more flexible, dynamic, and try to be more collaborative instead of static or conflictual with the issuer and the other constituencies in the markets. So without going into the details of each proposal in the Lord Hill's review, let's look at the free float, for example, right? The free float, it has to be looked as a liquidity indicator. It cannot be considered as a governance factor. So 25%, why if you have a big company, you need to get fixated on 25% of a company getting listed? If this is a liquidity provider, a liquidity factor, there are many other aspects that can be kept in consideration. Or the financial track record, the listing regime is currently giving exemption for scientific-based company. This is the old world. Now this new concept has to be adapted to the new companies we are seeing. And then the last one is the SPAC. I mean, it's clear that London has currently lost a lot of opportunities of clients that are pursuing the opportunity of SPACs. And just because there is this rule of the reverse takeover and the listing regime, whereby there is a trading suspension, again, investors, they can get much more flexible terms and conditions in other markets without compromising the governance or their rights in any way. So why would an issuer decide to come and list a SPAC in London? There is no real justification. So again, I think I've taken already too much of a time, but I conclude my thoughts just saying that I really like what Lord Hill says in his paper, saying that his suggestion is just a way to try to close a gap between London and the other markets. They should not be seen as someone that is trying to create a gap with the other global centers.
Thanks very much, Sylvia. And I think those sentiments they reflect a change in the market as compared to when the last root and branch listing review was undertaken about 10 years ago, where actually a lot of the proposed changes that Lord Hill has recommended were considered, but in actuality the listing review didn't change much. This seems like there's, as you say, much more impetus behind it. So let's see what the first poll has resulted in. So if you remember, it was a sort of balance between investor protection and attractiveness, and you'll see. I'm hoping you'll see on your screen that 90%, just under 90%, felt that either the Lord Hill's recommendations were appropriate or actually didn't go far enough in making London as an attractive listing venue. And I think, that may be a reflection of the change in sentiment, the recognition that London's position is different to where it was 15 years ago, or perhaps a reflection of the fact there aren't many many investors dialing into the webinar, but that remains to be seen. So turning to our second poll before we turn to Charlie. So looking forward, the question is, looking forward 5 years, do you think London will have A, increased its share of the IPO market, or B, lost ground in terms of IPO market share? So, of course, when we're talking about London as a listing venue, we're really talking about the London Stock Exchange. So turning now to Charlie for a view from the exchange.
Thank you, Jonathan. So I thought it would be interesting to firstly touch upon sort of where do we see the UK capital markets today, talk a little bit about what are some of the emerging trends, globally, and then talk a little bit about how the Hill review sort of positions the UK going forward. I think the first thing to say is we sometimes hear quite a lot of negativity about the UK's capital markets, but it's worth reminding ourselves of some of the positives as well and some of the facts. The UK was the largest capital market in the world for equity capital raisings last year outside of the US and China. So we had just over £50 billion of equity capital raised. And that wasn't an anomaly. If you go back over the last 5 years, that's sort of consistently been the case. And when you consider that the US and Chinese capital markets predominantly serve their domestic companies, and they have far larger economies, that's, they'll always have an advantage. In Europe, there was almost 3 times more capital raised in London than there was on the next largest European exchange, which was Frankfurt. There was 8 times more capital raised than in Amsterdam, which has gotten a lot of attention recently. And I think the unique characteristic of the UK's capital markets, and sort of this is beyond its respected regulatory regime and legal system and physical presence of advisors and investors, is that it's a market that's home to both UK companies and international companies. International companies make up 38% of the companies on our market. That's the largest percentage of any major market in the world. So I think there's a lot to be positive about, but markets are changing, as they always have done. And so we need to be aware of and respond to those changes to make sure that the UK remains competitive and retains its position. And so I think there's a couple of challenges that are worth discussing, and Philip mentioned some of these. The first is that the number of companies listed has declined. That's true of every developed market in the world. It's not necessarily just specific to the LSE. That doesn't mean we shouldn't be worried about it. It's just the fact that it's a developed market trend. And there are several reasons for this, right? The depth of private markets has grown enormously over the last decade or two. So companies are able to fund themselves in the private markets for longer. The low interest rate environment has meant that private equity has become more competitive, and you've seen the increasing regulations put on listed companies. Now, this decline is a concern globally. Listed equity markets are a great wealth equalizer. They allow individual investors to share in the growth of an economy in a way that private markets can't. So from our perspective, it's a trend that needs to be reversed. We need to make sure that public markets are seen as an attractive source of funding for companies relative to the alternatives that they have. The second challenge, which is a bit more of a specific one to the UK and European capital markets, is that the markets historically haven't had enough large high growth companies. Often they're from the technology sector. They don't necessarily need to be from the technology sector. And again, this was a point that was raised previously. And the reason for this is relatively simple. The UK and Europe were behind the US in incubating a lot of these high growth companies. And as such, there simply haven't been as many of them that have been looking to access the public markets over recent years. The good news is that's now starting to change. So over the last 7 years, there have been more technology IPOs in Europe than there have been in the US. They've been smaller in size, but they've been larger in number. And the UK government and the broader ecosystem have done an incredible job in incubating these companies to the point that we now have the third highest number of unicorns in the world outside of the US and China. What we now need to do is make sure that the UK remains an attractive home for these companies to access the public markets. And we're sometimes asked, well, why does it matter that a company chooses to list in the UK? We've seen time and again that when a company lists on a market outside of the UK, their center of gravity shifts. The company's incorporation normally changes, their headquarters change, and then slowly jobs move. So it's important for the UK to retain these companies here. Also, from a markets perspective, what we know is that when you build up a cluster of companies on the exchange, particularly if they're domestic companies, because of the international nature of the London market, international companies then follow. And we're starting to see this already happen. So if you think about technology companies accessing the exchange, in the last approximately 6 months, 45% of all of the IPO proceeds on the LSE have been by technology companies. We now have almost 200 technology companies, which is about 10% of all the companies on the exchange. So whilst those are some of the specific challenges, I think it's also important to recognize that capital markets more broadly are evolving very quickly. And that means that the UK has an opportunity to be a leader if we can be nimble. And the Lord Hill and Khalifa reviews are partly about that. You take ESG as an example. Investors want more information on the ESG credentials of the companies they're purchasing shares in. Well, this is an area where the UK can and is leading the world. The UK is hosting COP26 in Glasgow in November. The LSE was the first exchange in the world to launch a green bond market, which we did in 2015. We now have 265 bonds listed on that market. They've raised more than £60 billion of capital. You could take the example of individual investors calling for more access to IPOs and follow-on issuance. Again, the UK is leading the way on this with apps that allow investors to participate in those transactions. What we believe is the world's first in-app IPO actually went live earlier this week. And so whilst there are challenges, there are also opportunities for the UK's capital markets to do sort of what they've always done, which is to continue to evolve to meet the needs of issuers and investors, which is a lot of what the Lord Hill and Khalifa reviews are focused on. I think specifically on these reviews, and again, this was a point that was made earlier, we believe that London has built its reputation as a global financial centre based upon high standards. That reputation has been hard-earned and it needs to be protected. And we believe that the recommendations in both reports protect this status and are a sensible evolution of the existing rules. You know, Lord Hill has said this is not about opening up a competitive gap versus other markets. It's about closing one which has already opened up, which we agree with. We also more broadly think it's sensible that in any market, you should periodically consider whether regulations are achieving their intended outcomes as that market develops over time. Are the rules delivering material benefit? Are there better ways of doing things given changes in technology? I'll give you a few examples. At the moment, an IPO in the UK needs to be open to retail investors for 6 days so that you can post them a prospectus. And that's one of the reasons why retail maybe haven't been included in as many IPOs as they otherwise would have been. So in a world where we no longer post prospectuses, it seems sensible to consider whether or not that time period could be shortened, while still giving people plenty of time to read the documents. Another example, currently most companies raise capital either through an accelerated book build, which is done in a single day but is not preemptive, or they'll raise through a rights issue, which takes about a month and is fully preemptive. Is it possible now to use technology to both provide preemption to investors and allow companies to access the capital they need more quickly? It's done in other markets of the world. Could it be done in London? Sylvia touched on the point around free float. You know, the purpose of free float is to ensure sufficient liquidity in the aftermarket. So in a world where companies are larger at the point that they're accessing the public markets because they've had multiple funding rounds, does it still make sense to apply the same 25% requirement to a £1 billion company as to a £40 billion company? Or could you use a triangulation between percentage, pound million free float and number of shareholders, which is what they do in a lot of other markets? Again, we think it's a question that's worth asking. It's a question that's worth consulting on. So I think from the LSE's perspective, we believe the UK capital markets have always innovated, they've always adapted, they've always helped shape global standards. And these reviews are really about making sure that that legacy continues and that we're well positioned for the future.
Great. Thank you, Charlie. It's good to get the view of the LSE, which leads us nicely to our second poll results, which is, and I hope you can see these on screen, which is that 38% of you who participated think that London will lose market share, and 62% will. 38% will gain market share, 62% will lose market share. So it's interesting that while the vast majority of the participants think that the Lord Hill review is moving in the right direction, that the impact it might have on London's position is uncertain. And actually, that leads us to one of the questions that's come in. And perhaps Philip, if you want to take this one, it's essentially. How much effect can rule changes have in making London a more attractive listing venue if there are other issues which are preventing that from taking place, like the valuation point you made, like the fact that management compensation packages are much higher compensation packages are tolerated in the US as compared to Europe and London. So how much impact can changes to the rules actually have when you have those other buy side or investor issues?
Well, those are clearly significant issues. About management pay and the valuation you get somewhere else, and that kind of will be just more reflective of the company itself, and what they're most concerned about. Having said that, can the rules make a difference? Yeah, certainly. I think there's a lot in that report. To be fair to Lord Hill, is we focused on SPACs and free float, but there's a lot of things in there that we haven't touched on, and we can look at all these tweaks. I don't think there's be ever one on its own, but you can start adding once you start building them all up, then it becomes a different sort of environment. I mean, one of the bugbears that many financial journalists have is about being able to get hold of a prospectus before a float, and it seems like it always has been a strange thing. Well, why can nobody see certain things before something is floated? On the face of it, you think, well, that never made sense beforehand. And in a digital world, it really doesn't make any sense. We had an issue the other day with well, not an issue, but an example with Deliveroo. I mean, its prospectus has come out and it's given us some. It's told you what its historical data is, and then somehow you've arrived at an 8 billion valuation possibly, and it's difficult to know how you got there because the company itself isn't allowed to actually share forward-looking and guidance until it's actually floated, and things like that. Once you start adding the parts like that up together, you think, well, they do form barriers, and especially in a digital world where we can hold a seminar like this. It really seems like they can move with the times. The issue about if on the CEO pay, that would have to be something that looked at in another part of the market. I think there are limits to what a listings review can do. It can improve the conditions, but there's only so far it can go, I think.
Thanks very much, Philip. And interesting. Obviously Lord Hill does, on the forward-looking information point, does suggest some form of ability to put projections in both IPO prospectuses and further issue prospectuses, but the detail, it remains to be seen how that will play out. But Sylvia, I don't know if you have a view on any of those the points just raised.
Yes, I just wanted to close and to complete what Philip said. I mean, this is a starting point, okay? And I think it's really important that the government has given this task to the Lord Hill and that they have a knowledge that there is something to be done. Will they manage to find a solution for all the issues? No, and I think they are very aware of it, but you need to start from somewhere, and I think this is definitely the right step, and they're moving to the right direction. So they've touched many points. Obviously, they cannot touch all of them in one single list review, but I'm pretty sure they will do their best in order to try to close the gap as much as possible. So it's a starting point. They will take some time, but they need to start from somewhere.
Great, thanks very much, Sylvia. Another question that's come in, and perhaps Charlie, you want to take this one, is have you seen a change in your discussions with companies who are considering a London listing now, following Lord Hill's recommendations and obviously the Khalifa review as well?
Yes, we have, is the short answer. companies are, if you look at, I mean, there's two groups of companies. There's some companies that will be directly impacted by the recommendations in the Hill review. So, for instance, Sylvia mentioned SPACs as an example. If those rule changes are implemented that Lord Hill has recommended, you'd expect to see more SPAC issuance. Then there are other companies that, other parts of the recommendations will impact, whether it's free float or the rules around dual class voting, for example. And we've noticed a meaningful uptick in engagement from those companies. And so those are sort of bucket one, if you like, of companies that will be directly impacted by the review. What's interesting is that then more broadly, even companies that aren't necessarily directly impacted by the review still want to talk about it. And I think the reason that they do is because there's a perception that London is sort of back on the front foot, wanting to work with companies, wanting to work with investors to try to remove as much sort of grit or inefficiencies in the system as possible. Philip mentioned things about forward-looking prospectuses as an example, or forward-looking statements in prospectuses. That's an interesting thing that people want to talk about. Many companies do want to put forward what they feel the future prospects of their companies are. So we've certainly noticed a change. Even clearly the FCA will consult on many of these rule changes, and then they said they'll implement them before the end of the year. But even prior to that, we've been getting quite a lot of companies wanting to talk about it.
Interesting. And then on the client side, Sylvia, have you seen companies considering London or reconsidering London as listing venues in light of the reviews?
Yeah, I think the one that are first impacted are, as Charlie mentioned, the SPACs client. The reality is that we have a solid pipeline of SPAC candidates that they haven't looked at London because of the restriction. And now that the news are out, they're actually saying, can we kick off the project for a London listing? So, this is definitely a very real and short-term change in the ask from the clients. Unfortunately, we need to have some further measure to be implemented before we can actually kick off a project for for listing a SPAC soon in London. But we have definitely seen a shift of clients' ask. And then another very recent example, we were dealing with a client just a few weeks ago, and they really wanted to list in London, but there was the 75% rule in terms of track record, which was seen as an obstacle for them, because this was it was a growing company, which have been doing several acquisitions over the past 3 years. And for them to present 3 years of historical, including 75% of the business into prospectus, would have been an enormous work, something that would put them off to do a London listing. So again, another example of them approaching us again and say, let's see what's happening, because if this being removed and you need just to present 75% of your business in the last year, then we would consider London. So definitely we have seen some real-time and live examples of clients that are interested again into the London Stock Exchange.
Great, thank you, Sylvia. Another question that's come in, I'm sort of paraphrasing here, is a premium listing segment IPO is, as I think you said, Philip, it's the biggest and the best companies that come to market. It's the companies that go into the FTSE indices. It's the companies that our pensions are invested in. To what extent do these recommendations and reviews amount to a watering down of those standards, and a watering down of which could well impact on the quality of the premium segment, and therefore the kind of companies that our pensions funds are invested in? So I don't know if I turn to Philip first for that one.
Well, I mean the person who came up with the question has kind of put the finger right on the issue. Does it represent a watering down? I mean, not necessarily. It's clearly you can have the places like Amsterdam allow the dual listings, allow the shareholders to maintain a lot more of their funds. It's easier for SPACs to float. It needn't necessarily be, but until we actually see some of the really fine detail, and this is only a report rather than even a white paper from the government. That issue about whether it's watering down. Don't know. I mean, I'm not entirely. It feels like a cop-out of an answer, so I apologise to the person who wrote it. But yeah, until you actually see some of the harder detail. The one thing I would point out, I would actually just add on this is that, yeah, you do get a lot of pushback from fund managers, and some actually, are very vociferously against it. Others are actually a bit more cautious. They kind of want to see more detail, and and then also, the thing you've got to bear in mind with fund managers is that they have indices and to outperform and targets to meet, and sometimes if everybody's in it, then you kind of have to be in it as well. There's only so far that your principles can take you before you hit your underperformance gets in the way. So yeah, I'm not entirely sure. I think possibly Charlie might be the better person to explain.
So I don't think it was a cop out, Philip. No, I mean we don't believe it is. Lord Hill makes 14 recommendations, I believe it is, in his report, and 13 of them aren't even specific to the premium segment. So we certainly don't view it as being a watering down. We do view it as being an evolution, and an evolution that sort of takes into account what's happening with markets sort of globally. I think a lot of the recommendations are much more focused on sort of adapting the existing system to be faster and more nimble, rather than a watering down. So we've discussed things like forward-looking statements in prospectuses, for example. We've talked about changes for SPACs, but also don't forget there's recommendations in there that the FCA are actually given more power to move faster and more nimbly when they need to. At the moment, not. Some of the changes that they may wish to make are in primary legislation. That takes a long time. So there's also actually recommendations in there about strengthening the regulator and allowing the regulator to move more quickly. There's a recommendation in there around the briefing of connected and unconnected research analysts. At the moment, the UK has one of the longest IPO execution periods in the world. Is that delivering material benefit? If fund managers say it is, then it should be kept. If they say it's not, then perhaps there's another way of doing things. So I think when we go down sort of the recommendation by recommendation, more of it seems to be around how to make the markets more effective, how to remove things that aren't necessarily delivering material benefit, rather than any sort of watering down of the standards.
Thanks, Charlie. And I think perhaps a final question. You mentioned the number of recommendations that were set out in Lord Hill. I wonder if each of you could pick a particular recommendation that you think will have the most impact on the market in London, and so just so you don't all pick the same one, if feel free to talk about another recommendation that you think is of particular interest and you'd like to cover. So perhaps Sylvia, I don't know if you'd like to kick off.
Yeah, sure. I think I've already covered more or less in my intro what I think are going to be the key ones. But for me, free float is definitely going to be a driving factor. I mean, as we have seen, the US removed the free float requirement a while ago, and this has proven to be a very successful move. Other markets in Europe They have a free flow requirement, but they are definitely much more flexible. They do not impose a very hard number. So I think this will, in light of the new set of and group of companies we are currently dealing with, and the revised structure of the founder and the fact that they don't want to sell, there are not many sellers out there in the market, then I think a reduced free float will actually help a lot. A lower free float will actually help a lot many companies to get closer to London.
Great, thanks, Sylvia, and Charlie. I don't know if you have a favourite recommendation.
Not necessarily a favourite. I think the one that I think will have the most impact would be the recommendation that a short annual report on the state of the city is given to Parliament each year, which sets out sort of progress made in improving the UK's competitive position. I think that sort of annual check, if you like, of making sure that competitiveness is an important factor and that the markets are working the way they should do, will mean that the markets are able to react more quickly and more nimbly going forward. So I'd probably single that one out.
Thanks, Charlie. And Philip, we can't get the whole webinar without mentioning dual class share structures, surely. But I don't want to lead the witness.
Yeah, no, not at all. I suspect it's actually it's not that one either. That the general recommendation, that's to actually kind of put more power within the hands of the FCA, to give it more discretion in terms of what it can and can't do, and I'm sure he'll probably be able to look at the prospectus directive and a lot of things that come under its remit. I think would be that might actually be the long term. That might actually be the most important factor.
Great, thank you. Well, we're coming up to 50 minutes, so it just remains for me to say a huge thank you to my panelists, Philip, Sylvia, and Charlie, for contributing to such an engrossing discussion. So thank you. And still to come in our Windows of Opportunity series are topics including SPACs, which we touched on this webinar, digital transformation, carbon and climate change, globalization of life sciences, and managing talent risk. So please do keep an eye out for those updates on our websites and join us for those webinars. So thank you very much for joining us this afternoon.